Okay, good morning everyone. This is the 2nd of February. I'll be delivering the briefing today. There's a couple of topics I want to discuss. It's obviously non-farm payrolls day, so we'll be going over some of the jobs report and what we're expecting, sort of market consensus, market view, and what sort of effect they will have on the market as a whole. But before we crack on with reviewing the data that's coming out, we're going to start off by reviewing the market yesterday. The price action we saw, particularly in the dollar, the euro, US and European equities, given the fact that I felt like it didn't follow any standard pattern. So after reviewing that, we'll discuss some of the currency moves with Bank of Japan stepping in to provide stimulus, which had an effect on the yen and therefore allowing it to break some technical levels. Following that, we're going to have a look at the jobs report coming out later, and then Sam's going to take over as usual to do the technicals. So let's start off by having a quick look through the charts yesterday. And yesterday, as I'm sure you guys are seeing, we were seeing some dollar weakness, which is of no real surprise. This is the sort of market condition we've been seeing recently. And you can see here in the Euro USD currency pair, strengthening euro versus weakening dollar, allowing the euro dollar pair to trend higher. Now there were some interesting opportunities here. The break of this pivot level, which was quite a strong technical price point, which was providing that resistance throughout the Asian session. We break classic opportunity and then continue to provide support through the European session, finally making a run higher coming into the late European session, and in the American session running all the way to R2. Looking at this on the longer time frame, we are approaching quite a key level of resistance. So having to go back to a weekly chart now to be able to find these technical price points. This is the real next region I think the market's going to run towards. There was a double bottom seen early 2012. We're likely to see a test of that today if we continue to see this dollar weakness prevail, just sitting above the R1 level. There's really no technical resistance levels before there, therefore I would expect the R1 to provide some good support today. But in terms of the technical setup, Sam will be on shortly to talk a little bit more through that. This dollar weakness we could also see in sterling, just a little bit less pronounced, however, just taking us from pivot all the way up to R1 and then sort of settling down. Now there were some hawkish comments coming out from the ECB as well yesterday, but nothing sort of above or beyond their normal hawkish commentary. So on that respect, we had the euro dollar trending higher on the back of the dollar weakness, and therefore the euro was strengthening. So quite a standard trade is to be looking to short the domestic market in which the domestic currency is appreciating, and therefore if we had a look at the DAX, this was one of the big underperformers. All sectors in the DAX indices was trading lower yesterday, and we saw quite a bit of heavy selling coming into this market, starting at around midday as the Americans were coming in. In terms of how you could have anticipated this, I think with the dollar weakness and the euro strength, going short US equities may have been a little bit more difficult, but given the fact that the euro was sitting quite high on the day, the risk off, I'm going to say loosely, move was more pronounced in the European equity market. Also, the DAX made quite an interesting move yesterday as I was watching it. In the 60-minute, we saw this big red candle over here, and the Euro Stoxx being quite a liquid product, it's unusual for it to move so aggressively. And there was no data at the time. If I just go back onto a 1 minute chart, and you can see that in 1 minute there was a bit of a pennant forming here, but in 1 minute taking us from S1 all the way down to S2, which is about a 12 to 15 tick move in 1 minute. So bottom of the range is just giving way, this continued selling pressure. Some stop losses definitely being run here. Very strong technical level giving way, then allowing your DAX to sort of move in tandem. That then took us into the American session. Let's quickly review what happened there. US equity markets, I mean, it's an interesting market because normally if we see, well, price action for the past year and a half would have dictated any time we saw any sort of selling, would see quite an aggressive bounce. Through 2017, the bounce used to come immediately on cash open, then later on in 2017 came on the US close. But to see this downside in US equities be quite persistent. The market not really bouncing has been quite interesting and unique. We haven't seen this for a very long time. This is, I feel, still some profit taking on the grand scheme of things. We're still sitting right up at the all-time highs, finally seeing a bit of a pullback. This is the S&P. In terms of the percentage retracements that we have seen, we're trading 2.5% off the all-time highs. Had the market gained 2.5% in one day, you know, we would be a little bit surprised, but wouldn't it be not really a talking matter. So we are testing some key levels, or going to be testing some key levels. Say if these give way, then yes, we may see some downside. But even if the market does run and makes this 5% correction, which people have been sort of touting that the S&P hasn't seen a 5% correction in over 400 days, well, we'll still be higher on the year, which is pretty incredible, taking consideration. So this is nothing too worrying on that front. But in terms of trading the correlations and trying to find opportunity, it was a bit difficult because as we were seeing this sell-off in equities, US equities and European equities, we weren't seeing a risk-off move. So we had dollar weakness, which should, in textbook theory, be supportive of US equities. But gold wasn't trading much higher on the session yesterday. Let me just enlarge this. Modestly higher, really still within its weekly range over here. T-notes wasn't going bid either. Obviously, this is following on from probably a delayed hawkish interpretation of the Fed, as we've seen yields continue to rise. This is the price of bonds going down, and therefore yields rising in anticipation of tightening from the Fed. And there was one trade that I was in, and I'm sure you heard me complaining about it in Trading Live at the beginning of the day. If somebody could remind the yen that the dollar is weakening, because I was short the dollar yen at the time. So if I bring up a dollar yen chart, it was trading quite an interesting area. 1/J16. If we just enlarge this chart, put it all the way onto a weekly, you can see that we did have some interesting technical analysis here. Just touching these lows. I'm sure it was a little bit neater. And you can see just this trend line holding, the market bouncing, and then if you went on a shorter time frame, we also had a trend forming from here all the way down here, which did provide, just missed it, did provide some resistance. So this was me trading dollar weakness,
comments here from the deputy,
expecting the dollar to weaken and the yen to go bid on the back of the risk-off move or the equities coming under pressure. That, however, wasn't the case. This trend line providing support, and then ultimately we've seen this yen weakness. And just to go about explaining why we saw this yen weakness, let's just flick over to one of our articles, and this was the Bloomberg article, which just summarizes the price action we saw. And what we were seeing in the yen, or this yen weakness that we've seen today, has been due to the Bank of Japan stepping in. The sell-off in the bond market has affected global bonds. If we look at T-notes and bunds, both of them coming under pressure and showing similar price action. There's global tightening of policy coming into play, and we have seen some hawkish commentary come out of Bank of Japan's Kuroda as well quite recently. So this selling of bonds has resulted in the yields. Oh, sorry, I wasn't showing my charts. I'll flick over them in a moment. But this is just saying even Japan hasn't been immune to the sell-off in global bonds, and has sent the 10-year Treasury yields to its highest in 4 years. After the 10-year Japanese government bond yield threatened to breach 0.1% versus a policy targeting of around 0%, the Bank of Japan announced it's prepared to buy an unlimited amount of 5 to 10-year notes at a fixed price. Japanese yields retreated and the yen declined. So this is just in line with the yield curve targeting we've been seeing from the Bank of Japan as their form of stimulus, aiming to maintain the Bank of Japan, JJBs at the 0% level, and this is why we've been seeing this yen weakness, as we've seen the stimulus. Dovish commentary, I really wouldn't call this dovish, it's more enacting what they've already told us they're going to do, which is maintain a 0% yield on JJBs. So you can see Bank of Japan steps in before yields reach 1-year highs, and we've seen the yield start to retreat. Okay, so that brings us on to the, let me just switch over here. just show you what I was talking about with treasuries coming under pressure here. So this is your US 10-year coming under pressure, and then you've got your bonds coming under pressure here as well. So the global bond market's coming under pressure, seeing this tightening. However, Japan's still struggling with its inflation, trying to keep inflation above water. So just providing that stimulus necessary to keep yields lower. If we then flick on to the data calendar for the day, coming up we have non-farm payrolls, as to be expected. In the European session, nothing really of note here. 10 a.m. European area. PPIs, so we got PPIs coming out again, lower tier 2 data, inflationary numbers, but not something which is closely watched. But I still would be careful, making sure you're unwinding some positions or de-risking coming into this. Nevertheless, they are inflation numbers, and given how sensitive the markets are to European inflation, given the fact that the euro is trading and the ECB is being quite hawkish, it should be unwise to be in full size coming into any sort of inflation number. So be mindful of this data coming out. ECB speaker, 10 a.m. At the same time, so definitely worth de-risking yourself coming into that. Coming into the US session, non-farm payrolls day, and as we're all pretty much comfortable with, it's not the headline which is of importance, it's your average hourly earnings, which is going to play the most importance. Now there's an interesting article, if I flick over to here, just to suggest what we're going to see from this employment report. And so this is Deutsche Bank just going on and talking about what they expect, and they've said that they expect non-farm payrolls to be a beat on expectations, or quite a sharp upward move in job creation. So if you have a look at where we've been trading, 148 was the last reading. However, around 200 being the average job creation month on month. In terms of expectations today, consensus for 180. Deutsche Bank is saying this may be breached, as what we've been seeing recently is an over the ADP and ISM non-manufacturing has been showing a much higher print than your non-farm payrolls number, and this overestimation often has a lagging implication on your NFP numbers, and therefore now expecting quite a sharp move higher in these numbers over here. But job creation, lesser importance. What is quite interesting of note is some of the statistics that they were going through, and if I can just quickly find them here. And what they were basically saying is that, okay, here we go. A beat on average hourly earnings is almost always led to higher yields and strongest and a steeper curve to be expected, even if the headline payroll gains miss on the downside. So this is saying even if the jobs number is a miss on expectation, and the average hourly earnings is a beat, therefore we see the curve start to steepen and we start to see yields start to rise. This is just showing that the market is far more concerned with the average hourly earning numbers and is therefore positioned as such. And what are we expecting in today's numbers? Hourly earnings. Average hourly earnings year on year. So average hourly earnings month on month, consensus for 0.3%. Having a look at the charts, this is on the higher end of your 12-month average, apart from the massive 0.5% we saw during the hurricane season, which I think was artificially influenced. Year-on-year readings, consensus of 2.6%. Something worth note is US inflation is currently tracking at 2.1%. So looking at a very simplistic model, if your US inflation is tracking at 2.1%, the average hourly earnings year-on-year, just taking the same sort of time frame of reference, is tracking at 2.5%, then in theory there is extra money available to consumers and could therefore lead to sort of inflation building up in the medium term, which I think is the market view, and especially Deutsche Bank are expecting this average hourly earnings and inflation to start to pick up come the third quarter, which is only about a month, 2 months away. So that's your jobs number. Sam's going to be on just in a moment. Just before I leave, I could not take this opportunity just to mention Bitcoin is getting absolutely demolished, coming down to test 8,000 on its lows, down 54% since its December highs. So any crypto traders out there, I hope you got out, you booked some profit, and you haven't been using a dollar averaging method of buying into this as it's been going down. But yeah, anyways, I'm going to leave it to Sam to check the technicals out. Thank you very much, guys. If you have any questions, please do let me know.
Yeah, thank you, Vas. Let's just have a quick look over the currency markets to begin with today. Obviously, you've got the main reading out at 1:30 this afternoon, so I won't be expecting too much from this morning. You can see, obviously, I think Saif has put this trend line on. Definitely something to have on for the S&P. But to begin with, for the euro, which has seen yet again, well, as things stand, looks like to be another week to the upside. Just coming back down here, you've got yesterday's, I should say Wednesday's high around the pivot level, which looks a good area of support as things stand. But of course, the data can come out and go either way. And I mean, speaking of the data, I think it's important to after the numbers, to let the market have that digestion before making a decision on which way to go. But euro, yeah, definitely worth having a look at the high from yesterday in the pivot area, just sort of containing that range. If we were to come down below the pivot, it sort of does open the door to the 125 and the pullback we saw before the further up move to the rest of the evening yesterday. So keeping an eye on that. Let's just have a quick look over at the dollar index this morning. Just to see how that's going on before we'll come back to that. I think that is just about, yeah, just up a bit this morning. So the dollar is strengthening a tad here. Dollar CAD just caught at the corner of my eye, just pushing on as well. If we have a look through here, you can go pushing higher, and that is yesterday's quite interesting support, then turn resistance level that we're breaking through here. So just keep an eye on that market. Obviously the data out of the pound, 9:30, to be aware of. So I wouldn't necessarily want to jump into a trade for that market. The pound is finding support on yesterday afternoons / evenings low point there. So worth keeping an eye. If we can come back down, S1 looks technically strong with the use of yesterday, the low point here at 2 o'clock. If we get a bit of a trend line going as well, it looks like it might match up, albeit quite roughly around that S1 area. So it looks quite nice from a technical point of view to perhaps get into a long point around there. But again, the data could change things. To the upside, I would have just a bit of a rough trend line going forward for any targets, just to be aware of that. We do look like we're sort of topping out around the top of those highs of the day. So it's getting a bit lower. So we'll definitely have that on for anyone looking to get long later on. Equity markets, just obviously the DAX has been pushing lower, and it's just as of a few minutes ago made a new low, and I think the bias still has to be to the downside. In terms of levels where we perhaps may find a turning point, let me just clear everything up here. The DAX obviously now down for the year on the continuation chart, but this looks like a strong level where we did find support actually on the first trading day when we went lower. Could be an interesting area. Could we get down there today? I don't see why not, really, the way the DAX was moving yesterday, and it is having that negative effect as well, leading the way for US equity markets, which are currently on their lows for the week as well. So the S&P just pushing through that S1 and support level. Opportunity there if we were to pull back. The Dow as well just coming down to its low of the day, broken through a nice trend line that was forming there. Good opportunity. We'll be waiting for pullbacks if not already in, but there does feel like there is more room to the downside now. In terms of where we could find support maybe later in the day, if we look here at the Nasdaq, obviously it's now looking to break through what has been good support over the last couple of days. Strong level, but if we fail to hold there, this area interests me quite a lot in the Nasdaq. So higher than 90, broke through, but haven't really come back to test it since. So I'd be expecting some support around here. It'd be a case of judging it and the speed that it does come down, though, because obviously you could see the buyers looking to get interested in around there, but obviously a breakthrough there does open the door a bit, so it would be better off just waiting for price action around there before looking to go long, if that was your view. S&P, let's have a quick look over where a similar level could be. Obviously I haven't got any other technical tools on here, so if you do have your moving averages, etc., it could be quite good to have on. This point in the market interests me quite nicely here, the low of the 19th, so similar sort of day. I would expect some brief support around this area here where we came down on the 21st, but it does, from a sort of opportunistic point of view, look like there is a bit more room to this move to the downside in US equities. The Dow, which has found really strong support yesterday, you can see the bounce there from the cash open. I'd feel if we were to push down even further, where could be a good point, I mean the one that stands out is all the way down here. Don't think we'll get down there anytime soon, so it might be worth looking back at this sort of point in the market here, which ideally for the US equities, what's happened in the past is when they all come to a support level at the same time, where we have seen significant buying before, the reaction could be quite strong, and that could lead to the move higher. But I think definitely having a look at the DAX here to see if that really does continue aggressively will help drag down these US equities as well to perhaps these points in the market. The FTSE as well has been taking a big hit, obviously weighed on by the fact that the pound has been stronger. I was looking at this level yesterday, and it does interest me from a, let me just sort this chart out, a longer sort of term trade. The low here of the 14th, buyers really did take over at that area. If we can get down here today, I know this is the CFD, so if you trade on futures it may be a different level, but strong point in the market where I would expect to see a bounce here, and I think it's a good sort of medium term trade, perhaps to look to hold there if the pound sort of slows down a bit and this equity sell-off does find support. Gold, let's have a look. Obviously the focus for gold and T-notes, as I'll come on to, is very much going to be on the US data, as it could absolutely drag it around. Pivot, however, does look like a pretty strong area. We found some good resistance around where the pivot is yesterday before breaking through, so I'd expect something quite nice around there. However, we are making new lows for the day, lower highs I should say, for the day, so just keep an eye on that. If we do get squeezed into through the low, it could be a bit of a technical break lower for that market, so definitely something to keep an eye on. Obviously, as Saif mentioned, Bitcoin getting a hit nearly, well, I guess you can say this for Bitcoin, it is nearly at 8,000, even though you've got 300 to go, but yeah, on the low of the day, new 2018 low there. Let's have a look at pound just before we wrap up, just finding a bit of support on that level mentioned around here from yesterday evening. Any questions, get them in the chat please. Obviously I'll share my feed as well, so anything that I do see of interest I'll be pointing in. I would expect a relatively quiet morning, as usual is the case with non-farm payrolls, but I'll catch you in the chat, and if I don't speak to you, hope you all have a lovely weekend.